To get started so that we have, can everyone hear me all right? All right, I'm Hans Morris, and we're going to talk about B2B payments, which just might be the hottest sector right now. It's certainly the hottest sector in payments. So personal consumption expense is how, what consumers buy. So businesses are approximately twice the size of that market. And you had the IPO Bill.com earlier this year, many very large VC funding rounds, and both MasterCard and Visa said this is the most important area in their strategic growth. So let me give you a very quick overview before I introduce the panel so you have some context about the things that we're going to talk about. So really all the processes that businesses use to make and receive payments is several decades old. About 40% of payments in the United States are still made by checks, 40% of business payments. Another about 34% is ACH, and anywhere from, I'd say 10%, maybe even more, require manual reconciliation of ACH. So this is, and all the processes that lead up to the payment or after the receipt of the payment are also very old. So all the workflow, all the approvals, that is, most of that was designed and built in the 80s and earlier in some cases. So what's the problem with all this? Well, all businesses have a lot of changes to do, and what the big catalyst is you also have real-time payments. So real-time payments, you probably heard about the Federal Reserve debate to create their own real-time payment system, but the clearinghouse has a real-time payment system live in the US right now. There's also a same-day ACH, which is live. Visa and MasterCard both have push debit transactions, which are real-time, and 25 other countries have or are soon going to have real-time payments. Why is that a big deal? Because real-time payments changes the whole nature of working capital. How much working capital you need is very fundamentally changed if suddenly everything can be real-time. But you need to reconcile that. You need to process it. And you need to manage multiple different approaches and rails to optimize that solution. So this is as big a change as has ever occurred in the payments world is happening right now. And how many people know anything about this? Raise your hand if you could explain do real-time payments exist in Brazil yet? Can everyone know that? Okay, so we're going to cover, this is why you need to really pay rapt attention to this panel. And we have three excellent presenters here. So to my immediate right is Mike Prager. He is the CEO of AvidXchange. That automates the invoicing for businesses and decision processes, mainly focusing on medium-sized to larger companies. This is a pretty big company. It's been around for now
20 years.
20 years. He was a really, really young, cool guy when he started. Now he's middle-aged, cynical. But they also generate a lot of income. There's a big part of the change is what's called VCC, virtual credit cards. Everyone know that? Who doesn't know what VCC is? Everyone here knows what VCC is. Okay, we're going to talk about it a lot. So this is you're paying someone, you're generating a single-use credit card number, and so the person is accepting a credit card and you're generating income through interchange. That's a big development. Many business models have that as part of it. Okay, and then next to Mike is Patrick Kann of Papaya, which is here in Los Angeles. That simplifies the way billers get paid. It's a bill pay system with the consumer making it easy for all kinds of billers to receive a VCC and to accept payments. It really is made tremendous market share, viral growth. It's a remarkable company. And then Richie Serna of Finix. So many people have been talking about, let's just add payments into a software stack. You have restaurant software, you have doctor's office software, all kinds of software stacks. Let's add payments. They now make that a simple installation with a single stack through APIs, and now you are in the payments business. And all of a sudden, your lifetime value goes up significantly. Your ARPU goes up just by integrating payments. So that's Finix. Three incredible companies. All of these are very highly regarded, highly valued. So I'm going to ask each of the CEOs, and we'll start. Why don't we start, Richie? Let's start with you. So what is the most competitive distinction that you have, that Finix has, which causes customers to come to you? What is actually utterly distinctive about Finix?
I think one of the things that we really focused on from the first sort of
architecture designs was really optionality. So optionality in terms of the different payment methods that people could accept, so being able to accept payments via ACH, card, any form of digital wallet, but also being able to do that on the disbursements as well. Any of the customers that we're dealing with are really platforms, right? They're basically moving funds between multiple buyers and multiple sellers. That introduces a whole host of requirements and different sorts of value propositions for our customers to be able to pay out their sub-merchants faster, whether it's real-time payments via same-day, or not necessarily real-time, but same-day ACH, regular ACH, wire, Visa Direct, MasterCard Send. We really want to be able to provide something that's future-proof, something that's very extensible. So whether you want to bring your own processor, bring your own acquiring bank, we can support that.
Mm-hmm. So give an example. What type of client? Pick a client, say, how did you help them and why did they pick you? What was their other choice?
Yeah, so historically there's been sort of two ways to bring payments to this type of vertical SaaS model. You either outsource everything entirely to someone like a Stripe, you payment arm and a leg, it's very easy to get off the ground, but really you start hitting this sort of inflection point where the scale of their business model just doesn't work. Right? When they're taking basis points, that's a huge chunk of the margin of any of these businesses. The other route is to go down the sort of Uber, Airbnb model, which is basically do it yourself, right? Go build out a 170-person engineering team, invest years of upfront development, and then actually maintain that going forward. Most companies don't want to do that. What Finix is able to do is provide a third option, right? The same sort of economics that you would get with somebody like an Airbnb and Uber's sort of do-it-yourself model, but the same ease of integration that you would with any developer-friendly platform. Mm-hmm. So in terms of the sort of customers that we work with, one would be Club Essential. They basically provide software to the health and private fitness studio industry. So historically, if you're starting your own private club, you don't have an army of engineers to build out the accounting systems, the website, the inventory management, the CRM tools. Instead, you go to Club Essential. They can provide that package. And so rather than just monetizing the software for each one of these clubs, every single club would pay them a few $100 a month. They can start taking 2.5% to 3% for every single membership that is paid through their system, for all the purchases that are made through the bars, through their golf club, anything where there's money flowing through their system, they're now monetizing that.
Right, and so rather than integrating with Stripe, you can basically commoditize Stripe. You can make it so Stripe has to connect to you, and it makes it easy for your client to switch to other providers if they want to.
Absolutely. So basically, the way that we describe it is that they're basically turning payments into sort of cost of goods sold, right? Everything else that they charge is now the margin that they can be taking, right? Mm-hmm. And so you have this massive $2 trillion market in payments worldwide. Stripe is worth $35 billion. There's a reason why they're worth $35 billion. They are making a lot of money off of each one of their customers.
You want to make them worth $34 billion.
We want to basically say, hey, look, you're the one, the software company who's doing the hard work. You're going after the merchants. You're signing them on. You're providing the most of the value. You should be collecting the bulk of those economics.
Okay. So Mike, let's talk about what is the competitive distinction that AvidXchange has, and give an example of the client.
Yeah, so at AvidXchange, we focus on automating the accounts payable and payment process for middle market companies. And so what makes us unique is we put together really three distinct business processes in one SaaS platform, one software tools to automate the accounts payable process from invoice receipt through all the accounting approvals, allocations, coding, things like that. And then we have the payment side where our buyer customers use our software to manage their payment process that's highly integrated as part of their core accounting system. And then we've incorporated the supplier side where they interact with our payment network to get all the data they need and how they apply payments, along with our supplier financing engine, which we call Invoice Accelerator, which then allows those suppliers, they can actually accelerate any invoice for next day payment if they choose to. So combining those three business processes in one platform is what's made us kind of highly unique. So our go-to-market strategy for what we call our buyer customers is we focus on specific industry verticals, like the real estate industry, construction, financial services. And so, since we're, a lot of financial services people here, we'll take an example of a bank. So we have 2,000, regional and community banks that use our platform to manage their internal accounts payable and payment process. And then they'll interact with their suppliers to be able to receive electronic payments from them. And before that, these banks were printing paper checks and sending paper checks out in the mail to get their suppliers paid.
Yeah, and so who would you compete? Why would they choose you versus who would you say is the vendor that you face up against the most?
Yeah, so our kind of competitive profile is very different. It's vertical by vertical, and we don't have really competitors that go across verticals. And on the payment side, most likely a lot of times it may be a bank.
Yeah.
But our kind of secret sauce is that we're integrated 152 different accounting systems in a very tight way, which from a bank perspective, it's all about maybe like send us a file.
Right.
And
You automate the workflow before it hits the bank.
Exactly.
Yeah.
So our team loves competing against banks.
Yeah. And how many of your customers actually don't have any software solution before you show up?
Yeah, almost 100%.
Yeah.
So we'll do 1,000 new logos this year, and 99% of those will be greenfield. In our market, profile, that middle market, companies between 5 million and 1 billion, over 70% of that market is still managing paper invoices and paper checks.
Right. Okay, so Patrick, now your customer is usually a consumer. So what is your competitive distinction? Why are they choosing you, and what's happening in the bill pay industry, and why is that so beneficial to your model?
Absolutely. So the inception of Papaya was that in the US, 67% of the families suffer while paying their bills. It's the number one source of stress and anxiety by far. Aligned with that, only 2.4% of bills and invoices are paid via mobile device, which is a huge anomaly. I think most of you work in payments, and this is very well known that there is very low penetration. So we spent a lot of time understanding why this anomaly and how to crack the code. And that's the inception of Papaya, and we cracked the code. And to make mobile payments from, let's say, 2.4% to over 50% as it should compared to any other vertical, we needed to develop a technology that has 3 pillars. Number one is a business model that is free. It's very obvious, a convenience for consumer. A convenience fee model would not work. The second one is it needs to be frictionless, which is very much easier said than done. And the third one is it needs to be universal. So if you're going to have, let's say, an app on your phone, you have to be able to pay anything and everything. So we developed a number of technologies that comprise the 3 components, but one of them got a lot of traction, particularly from billers offering that solution to their consumers. So we developed technology that you snap a picture of absolutely any bill, any invoice. It doesn't need templates. It just intelligently extracts all the data. And we developed 18 methods of payment automation so that any bill, no matter nature, is paid. So we have partnered with over 100,000 businesses, mostly organically, and they are offering the solution to their customers. And for us, it's similar to what Mike has been saying. It's greenfield. Most of our billers that we partner with do not have an elegant mobile solution. So it's been very relatively easy to.
And they're accepting a virtual credit card. That's the fundamental business model. Yeah. So the convenience fees mean it's free to the consumer, no convenience fees. So you're not charging them a premium, but the recipient, the dealer in this case, is accepting that there's going to be a merchant discount.
Correct.
Right. So let's talk about. I want to talk about 2 key things. One is real-time payments. So how big a deal is this for your customers, and how do you see the landscape changing as a result of, let's say, many real-time solutions to send and receive? And I don't know who feels most strongly about this.
Well, so I can jump in at the start, and I'm sure it'll be a good discussion.
Because we talked about this yesterday.
Mike
doesn't care.
I'll start. I'll continue to the dinner discussion we're having last night, and it's not quite say I don't care, but what I would say is we have very different customers who operate in very different ways, and so our core buyer customer that's making their payments, these companies operate in more like batch process. They have specific processes that they execute, like they may cut payments on Tuesdays and Thursdays or Fridays. It's part of their business process. And so the nature of doing something real time doesn't really resonate to that set of customers. And the same thing, what I'll say within on our network, on our payment network, we have about 600,000 suppliers. Well, utility companies really don't care whether they get, a payment, credit to them during the day or it happens at night. But when you get down to, smaller businesses or micro businesses, they do care. So in our case, probably the biggest use case would be with our Invoice Accelerator offering, where we're a supplier saying, hey, I want to get paid, and today it's next day. In the future, that could be, I can get paid same day.
Right.
And I think that would be, the value of, proposition. But I think, you have to really look at the customer sets and the types of customers you have and where the value points are for those customers to see where it would impact them. The part about real time that, I'm most excited about is the ability to wrap more data around the transaction than your kind of typical, basic ACH that exists today.
Right. Okay, and Patrick, what would you say about this? How much do your consumers care about, saying it's clear, it's settled, and how much do your dealers care?
Yeah, so I grew up in Brazil, and I had the privilege of seeing the real time being implemented in the country in the early 2000s. And it was a very magical experience for consumers, actually. And at Papaya, we do not take credit risk, so we wait for payment to settle to then finalize the payment via virtual card. And our number one question to customer support is why it's taking too long, why it's taking a few days. So maybe I probably agree with you that most businesses, especially if they're large, would not really care. But funnily enough, consumers do care. And the certainty that a payment is going to get done and people keep checking, that creates some anxiety. And I look forward to the implementation in the US.
Yeah. Richie?
Yeah, I would say it depends on the vertical, absolutely. We have some of our customers who it means everything, and others who never ask for it. We actually got started off originally sort of promoting ourselves as a push-to-card platform, so really being able to do real-time disbursements directly to debit cards. And we went out for our seed round, and we talked to a bunch of investors. We would explain, ACH takes 2 to 3 days for those funds to settle. With Visa Direct and MasterCard, you can basically settle it in 30 minutes or less, 365, anywhere around the world. And the first thing they said was, who cares? And so I think it really comes down to sort of a rich man's problem where you don't really understand sort of the impact of cash flow. And it doesn't just apply to consumers, but it also applies to SMBs. One of our customers, Cabbage, they're the big marketplace lender out of Atlanta. They have just recently gotten into the payment space, both the card present and the card not present world. We're really servicing SMBs. And for those SMBs, it means everything, right? Being able to get paid out 7 days a week, whether you're a restaurant, a bike shop. I actually, when I lived in LA for a year and I worked on a political campaign, and it would take us a week to get those funds paid out to us for those donations. It meant everything. I remember the day before getting paid out from our payment processor, that real pain of, can we make payroll today? Yeah. And so I really think that those are the things that a lot of businesses take into account, and it comes down to cost. Yeah. Other businesses are, they're entering into factoring, they're entering into, advances on their invoicing, and they're paying way more than, the 50 cents versus that it costs for Visa Direct just to get their funds a day or two earlier.
It's also, I think, lots of businesses, frankly, if you said, hey, I can push the transaction you real time, that replaces a credit card transaction. Much better. If they could reconcile it and you could push and receive, that's a pretty powerful business model. There's
Absolutely.
no PCI, there's no, it's like, I don't have any data. Yeah. Cash is here, that's it. And
the challenge, I think, is in kind of especially move up in the middle market is companies have invested heavily in automating their cash receipt process. Right. And so they just got done, lots of them investing heavily in automating virtual card as an example. So now, how likely are they going to now turn around and start investing in another payment process to automate? And the answer is at some point over time, I think they will. But, I think like all these things, the bigger the company gets, the longer the adoption cycle takes.
Yeah. So we have a couple minutes, and I don't know if people want to ask questions. I want to give a chance to people to do that. So if you have a question, ask for the mic, and we'll get it to you. So here's a question.
Thank you. So, very curious of your guys' opinion about, we are seeing the digitalization of credit cards and consumers, the way the consumers are paying through Apple Pay, Samsung Pay. Eventually, primary cards moving from physical to digital, and potentially, eventually, we're not going to need a card per se installed in consumer pockets. So that changed the whole dynamics from the merchant perspective on POS and how they acquire the transaction. So I'm very curious to see your guys' vision for the future around that whole technology change on the spectrum. And moreover, how that can impact Visa's MasterCard type of intermediary business between these transactions if they can get out of the loop, and of course the cost with that as well.
Okay, well, that's what I was talking about. We're saying a push transaction. You push the transaction to that retailer, even at the point of sale. It's a different model. But I don't know, Richie, you're saying you want to future-proof your business. How enable a business to be future-proof? But how could you do that? Enable a business to do everything that this gentleman said right now.
So I think what I heard was people are going away from plastic, right? Effectively moving away from credit cards and debit cards to other forms of payment.
Potential disintermediation.
It's interesting because I feel like we've heard a bunch of stories of companies that are trying to build their own networks, disintermediate Visa and MasterCard, and they always get with the same challenge, which is how do they get funds into their systems. We were talking to Coinbase 2 or 3 years ago, and they're like, we're going to destroy the payment networks. Visa and MasterCard, they're horrible businesses. They're taking money from merchants. It's not fair. And I was like, well, why are you guys talking to us? I'm like, well, we can't get money out of our wallets in Canada. So I was like, okay, how do you get money into it? Like debit cards? I'm like, okay, clearly there's a need for this. And so I think, luckily with the price of Bitcoin crashing, 2 years ago, I don't get those questions as often anymore.
I mean, in the Avid side, 100% of our, card-based payments are virtual cards. So we're configuring a 16 digits and creating business rules around it. But the most important thing in our world is the data that we provide with those 16 digits. And that's the most important element for our suppliers and how they receive that data so they can, apply it in their system to make sure they're crediting the right invoice, the right customer. And so the data is actually the most important part that goes with those 16 digits.
So let's talk about virtual credit cards for a second, because I think it's a big part of both business models. And the U.S. has higher interchange than any other country in the world. And as this becomes more and more common and even ubiquitous as part of B2B payments, what do you think about the pressure on interchange? And have you seen that? And do billers start complaining? And there's been some could this be regulated, or what's your take?
Well, we're just completing kind of the budget cycle, right? So this is always an interesting discussion, for us. And every year we forecast that interchange is going to go down slightly, and every year for the last 8 years it's gone up, and which is a good budget problem to have. But I think the reality is every year MasterCard and Visa have their April rate increases, and I think from a political perspective, there's just been zero pushback from a regulatory perspective on B2B commercial. All the focus has been on the consumer side, but I do think it goes back to I think it's more about the value proposition that you provide with the card. If you're just providing, a virtual card with no data and everything else, I think over time you're going to get pushback because people are going to say, I want to move to a different payment method because it's not giving me value. But if you're wrapping all the data they need in an automated way that's going right into their billing system that they don't have to have any human touch it on their end, also, and that's, people are happy to pay, 250 basis points for that fully automated transaction. So that's where I see the pushback is going to be if you're not providing value as part of the transaction.
Okay. Patrick?
So I agree with you, Mike. But looking to, let's say, 10 years, 20 years horizon, I think there could be pressure to decrease interchange. And the reason the interchange is so high is because there is a lot of inefficiency in the payment system in the US compared to other countries. So I think that in the long run, if companies like ours succeed by creating more efficiency, there will be a decrease in interchange, but it also means that we'll be building multi-billion-dollar companies.
Okay, and we have 22 seconds left, which is just enough time for all of you to give this group a robust round of applause. So thank you all for incredible.
Thank you.
Nice job.